Hi guys, welcome back to the channel. Over the past few days, I took some time to really dive deep into how Lemonade is doing. It's been a while since I talked about it, and considering it's still one of my top holdings, I thought it was a time for an update. After reading the transcript of their Q3 2025 earnings call and listening to a few management interviews, I can't help it. I'm genuinely excited. Lemonade, in my opinion, is still one of the biggest opportunities in the entire market. The potential is massive, and right now the company only owns a tiny slice of an enormous industry. They have all the characteristics to become a major insurance player and potentially a multi-bagger. I've been following Lemonade for more than a year now, and the thing I love most is that management always delivers on what they promise, and lately they've actually been outperforming their own expectations. Let's start with the numbers. In Q3, total customers reached 2,870,000. That's a 24% year-over-year growth. Even better, in-force premium grew even faster, 30% year-over-year, hitting $1.16 billion. This is a great sign of brand strength and cross-selling ability. That 30% growth was actually higher than Lemonade expected. They didn't think they would reach that rate until 2026. And remember, management expects to maintain 30% annual growth until they reach $10 billion in in-force premium. Gross profit also crashed it. It grew 113% year-over-year, reaching $8 billion. Gross margin improved by 14 percentage points, hitting 41%. The gross loss ratio, which shows how much of the collected premium goes to plain claims, dropped to 62% in the quarter and 67% over the last 12 months. Both of these are record lows. Lemonade stayed free cash flow positive, and while adjusted EBITDA is still negative at minus $26 million, it continues to improve. This puts Lemonade on track for its long-promised target of becoming EBITDA positive in Q4 2026. Now, before we get into AI, here's something important CEO Daniel Schreiber said. A while back, Lemonade said that their long-term goal was to keep their gross loss ratio below 75%. But since Lemonade has now dropped way below that level, again in Q3 it was 62%, and they expect another record in Q4, many investors are wondering if the loss ratio will keep falling. Daniel's answer was extremely interesting. He basically said, declining loss ratio and expanding gross margins are great, but they are not what Lemonade is ultimately solving for. The real metric to maximize is gross profit dollars, not percentages. He explained that insurance is incredibly price sensitive. So sometimes lowering prices, which implies an increase in the gross loss ratio, actually leads to higher gross profit because millions of new customers switch to the cheaper insurer. In simple terms, lower premiums means worse loss ratio, but cheaper prices means way more customers, and more customers means higher profit, higher gross profit dollars, and Lemonade will always prioritize gross profit dollars over margins. In fact, Daniel said, when we see an opportunity to trade higher loss ratio and slimmer gross margin for higher absolute gross profit dollars, we will take that trade 10 times out of 10. And over the last 2 years, while the loss ratio improved massively, gross profit surged 261%. So yes, over the long term, we should expect Lemonade's loss ratio to go up again. Not because the model is getting worse, but because Lemonade will choose to lower prices to attract millions of new customers and maximize gross profit. But in the very short term, Q4 and the next few quarters, they still expect the loss ratio to keep dropping. Now, let's talk about AI, Lemonade's biggest advantage over incumbents. The most impressive metric is how Lemonade is scaling. Over the last 3 years, in-force premiums has almost doubled, while operating expenses have stayed nearly flat. This is because policy underwriting and claims handling are largely powered by AI, not humans. So, as customer numbers grow, Lemonade doesn't need to hire a proportional number of employees, something legacy insurance simply cannot do. Daniel put it perfectly. We have essentially transformed our variable expenses into fixed costs. That's the hallmark of an AI-first company. Another key metric is the LAE ratio, which stands for Loss Adjustment Expense, the cost of handling claims as a percentage of premiums. It should be noted that this metric is influenced by economies of scale, and so the larger the insurer, the more they are expected to have a good LAE ratio. Large insurance carriers typically sit around 9%. Lemonade, despite being much smaller, is 7% on average across all products. In the last 3 years, Lemonade LAE ratio has been cut in half, Claim volume has grown 2.5 times, while the number of claims adjusters has actually declined. And this is thanks to Blender, their AI system, which now give adjusters the ability to handle 3 times more claims. And Lemonade expects to cut the LAE in half again as the business doubles. This is insane efficiency. Car insurance also improved significantly. Gross loss ratio improved 16 percentage points year over year, reaching 76%. In-force premiums from Lemonade Car hit $163 million, up 40% year over year. Even better, more than half of new car policies came from existing Lemonade customers. This means that the acquisition cost is essentially $0. It underscores the cross-selling power of Lemonade, which is extremely strong, and once again, it confirmed the power of the brand of Lemonade. As I've already said before, Lemonade was rated the most loved insurance brand by people under 35. And their strategy is working. Bring in young customers with low-cost pet and home insurance, then sell them more expensive products as they grow older and earn more. Before we wrap up, one last metric, Europe. Management said, our European business is doing spectacularly well. Customer count is doubling year over year, growth is around 170%, and the loss ratio is very healthy. I know I covered a lot in this video, but here are the main takeaways. Lemonade's AI-driven efficiency and predictive models allows the company to scale while keeping operating expenses flat. This eventually gives them the power to offer the lowest premiums in the market, which could bring millions of new customers on board. Growth continues to accelerate. This is their 8th consecutive quarter of acceleration, with in-force premiums up 30% year over year and a record 176,000 net new customers added. Lemonade is still tiny compared to the multi-trillion-dollar insurance market, but it's positioned to completely disrupt the industry. And that's why Lemonade, even after being up more than 110% this year, is still one of my top holdings. That's it for today. I hope you enjoyed the video and see you next time.